Our market master of the day is S. Naren, Executive Director and Chief Investment Officer at ICICI Prudential Asset Management Company. If I dare say, one of the best known contrarians in the market, someone who puts his money where his mouth is. He's been telling us, Naren, we spoke earlier in the year, at the start of the year almost, and at that point you were pretty cautious. You were still of the view, which you carried on from late 2022, that there is perhaps more pain to go. You were sort of advocating allocation to debt schemes, to debt as an asset class, basically. How are things looking now? I mean, your view has worked out pretty well. How are things looking now? Is a lot of the froth out of the system, and how much more downside, according to you?
See, at 17,000 valuations are much more reasonable, and the global macro people are just too short on everything, and we have a Fed meeting today, and it is possible that there can be a good relief rally. If all the shorts in the system have to be taken out, there can be a very good relief rally. Does it mean that you can have very big returns in equity from here? The answer is no at this point of time. But is the market tactically well poised at this point of time? Certainly, because the global funds have just turned too negative at this point of time without reason, because they had to go short somewhere and they found India a good place to go short. So I think tactically we are very well positioned, but at the same time we don't believe in very big market rallies.
Okay, Naren. Well, I guess some of that caution and a bit of a reality check is very good to always have on board. I want to talk to you specifically about India. I mean, we'll wait to see what the Fed does and we'll see what's happening to those Western banks. But with respect to the market here in India, I guess the good thing for investors is that now valuations have cooled off. We're no longer trading 1-2 standard deviations above our mean as we usually do. So in that context, which part of the market looks most attractive to you, where perhaps you would be happy to deploy fresh money as well?
See, clearly there are areas like banks, for example, which are much more reasonably valued at this point of time. The problem with banks at this point of time is every one of the domestic funds and every one of the global funds has roughly 25-30% in banks. So if there is a redemption, people have to sell 25 to 30% banks. So till you see good inflows, banks don't perform, not because it is attractive and unattractive, but because it is a big holding in every fund. So I would say banking is certainly something which is attractive. Certainly if you look at it, auto is attractive because of all the consumer discretionary stocks, this is one of the sectors where in the last 10 years there has been very low growth. So people don't put implied growth assumptions which are ridiculously high. If for the last 6 years, two-wheeler industry hasn't grown or passenger vehicle industry hasn't grown, people don't put implied assumptions which are very, very high. So that makes the industry much more reasonably valued compared to many of the other consumer discretionary industries. Clearly, telecom is a sector where there is still scope for over a next 2 to 3 year period for ARPUs to grow from here. So these are some of the sectors where there is upside potential. The way technology has been tanking, clearly that is another sector where there is scope for re-rating over a longer term period. Pharma as a sector has done extremely badly, and again it is a sector where there is scope for returns over the medium term. So there are multiple sectors where, as you can see, over the last 18 months to 24 months, valuations have corrected. And, if we get many new age stocks also very, very cheap in some of the NFOs, IPOs, if they were to happen, even they can be considered because they are no one is talking about illogical valuations. So if they come at very low valuations, even we look at some of the new age companies also.
All right. Hi, Mr. Naren. Always good hearing your thoughts, sir. Nigel on this side. I wanted to focus on two sectors that you just spoke about. One was on the banks. The PSU banking theme worked out very, very well last year. And I think you were in the camp that was quite positive on that space. Do you believe it still offers value? And on the telecom space, the ARPUs are likely to move up, and you've been positive on that space as well. What kind of hikes are you factoring in for this year?
See, everything that we decide, like for example, if you take telecom, it's not something that the ARPUs need to go up this year. It will go up over the next 2 to 3 years. Will it go up in the next 6 months? We don't know. It may go up, but will it go up in the next 2 to 3 years? Certainly.
Okay.
I mean, when can you can't actually exactly time. This is exactly like PSUs 2 years back. In 2020 October, most people said PSUs will never deliver return. Could we have predicted when PSUs will deliver return? It is something like that. You can't predict when the ARPUs will go up. Aren't Indian ARPUs very low compared to the world? The answer is yes. Will they go up? They will go up. Can we predict the timing? Answer is no. So that's as far as telecom is concerned. Banks have seen a first round rally and they are no longer as cheap as what they were. I think next, if there are no big credit events over the next 2 years, they can re-rate. But no longer are some of the banks as cheap, PSU banks as cheap as they were. They have corrected in the last 3 months, so that gives you scope for some near-term rallies. But for the banks to perform, we should not have credit events, and that is a challenge actually in PSU banks at this point of time. Because a year back or year and a half back, they were priced as though they will never grow, they will never be able to create profits. Today they are sitting on record profits. So from here on, you don't need profits to grow as much as to have that profit should not go down because of any credit events.
Just a quick point on valuations, right? We had Sanjay Mukim of JP Morgan and we were talking to him. He said the problem is that there is no historical valuation because valuations have only gone up over the last 10, 15 years. I mean, it's like an upward sloping sharp curve from where we were at 12, 13. Multiples have gone up very sharply. So when you say we are at 17 times now, 10-year average is 17 times. Just trying to understand how you think about these valuations. What do you consider a fair kind of multiple to look at?
See, actually, that's where I have trouble telling investors. 2008 to 2021, you had printing presses in Washington and Brussels. Even now, printing presses are on in Tokyo. So you have to look at valuations in the next 5 years. You have to take a call whether the printing presses in Washington and Brussels will again reopen or not. If the printing presses in Washington and Brussels will not reopen, you can't put the last 10 years valuations all the time because at that point of time you got zero in debt. And because you got zero in debt, people invested in equity. So should you use the last 10 years valuations or not? That's why when I tell investors you can't get 15% per annum easily in equity, people start looking at me as though I'm a bear. I'm not a bear, but I'm a believer in more moderate equity returns because you don't have printing presses operating in Washington and Brussels. If due to all the global events, if tonight if Fed comes and says I'm going to start quantitative easing, then I'll change my view and say we are going to get much better returns in equity than debt. But if Fed continues to say inflation is a source of worry, I am not going to print money, then you're still in a moderate return world. You're not in a high return equity world because 2008 to 21 was backed by record printing in Washington and Brussels, and every Indian corporate which was creditworthy could get money in global markets at less than 1%. Today, when they want to borrow in global markets, they have to pay 5 to 6%. That's a big change. And that change people don't want to understand. And that is why big returns in equity market require much lower interest rates in the Western world.
And that's such a beautifully put, Naren, and such an important point. So what is the framework you are using right now? I mean, of course, when the facts change, as you said, you'll change your mind. If QE starts again, you change your mind. But I remember that in our last interaction, you said that, macros are going to be very important in the next decade. So I'm assuming you have a view in terms of how you're thinking about this. Will interest rates remain relatively higher for some time to come?
See, that we don't know. That depends on the Fed. But what we told as the outlook for the year is SIPs, STPs, booster STPs, asset allocation, multi-asset funds, fixed income. This is what we said. After the market fall, we are saying there is a lower downside in equity than before, certainly. And that's the reason we called it multi-asset as the most important asset class. And look at what happened to gold recently. And it is not that gold is attractive at $2,000. We don't think gold is attractive at $2,000. But we believe multi-assets is the way to go because, at one point of time, gold protected portfolios. At some other point of time, debt will protect portfolios. At another point of time, equity will protect portfolios. But we are not in a high return world till the day Fed starts QE or till the day Fed starts saying interest rates will come down to 3%, we'll bring down interest rates sharply. Till that point of time, we are in a moderate return world and we are not in a high return world. And that's why we have been very, very focused on asset allocation. We have been focused on categories like balanced advantage. But at the same time, what we think is, value is done extremely well. We think growth and innovation is also something which we have to look forward. And that is something we are thinking about at this point of time.